Welcome back, Deep Divers. Today we're plunging into the fascinating world of building America, focusing our analytical spotlight on a company that plays a crucial, often unseen role. Installed Building Products, Inc., or IBP for short.
Right, kind of behind the scenes, but really important.
Exactly. Our mission today is to cut through the noise. We've got a comprehensive investment analysis report on IBP full of financial data, industry forecasts, strategic insights. You know the drill.
Yep, lots to dig into.
We're going to unpack all this for you, extracting the most important nuggets so you understand what makes this company tick, where its strengths truly lie, and what potential challenges it faces. Think of this as your shortcut to truly understanding a complex business operating in a very fragmented industry.
And our sources are incredibly rich, covering everything from IBP's core operations and strategic growth drivers, right through to its competitive landscape, financial health, and, the broader macroeconomic forces shaping its future.
So much context there.
Yeah, we'll be distilling this down so you can grasp not just what IBP does, but why its particular strategy matters, especially if you're curious about that intersection of construction, finance, and, market dynamics.
Okay, so let's kick things off right at the foundation. What exactly is Installed Building Products, Inc.?
Right, so IBP, founded way back in 1977, headquartered in Columbus, Ohio, they've quietly grown into one of the leading installers of insulation and a whole range of complementary building products across the United States.
Okay.
Their primary focus, and this is really key, is the U.S. new residential construction market. They serve as a critical link in the supply chain for home builders.
And when you say installer, what does their business model actually entail? Are they just like subcontractors showing up to put in insulation?
That's a great question because while they do function as a subcontractor, their business model is, it's quite straightforward in its value proposition, but actually remarkably clever in its execution.
Ah, okay. How so?
They actually provide an end-to-end service for residential and commercial builders too. This means they handle basically everything from directly procuring materials, often from the big national manufacturers like Owens Corning or Johns Manville.
Right, big names.
Yeah. Then they manage all the logistics to get those materials to the job sites, and then they perform the final quality installation themselves.
So they're taking a lot of the headache away from the builder, essentially, managing that whole piece.
Precisely. This end-to-end control is critical for builders. I mean, imagine you're a national home builder trying to manage dozens of individual subcontractors, each with their own schedules, their own material needs across hundreds of projects.
Nightmare.
Yeah, exactly. Reliability, efficiency, and consistent quality are absolutely paramount. IBP aims to be that trusted partner who just takes that piece of the construction puzzle entirely off the builder's plate.
That makes a lot of sense. And what are their main offerings within that end-to-end service? Is it just insulation?
Well, while they offer a broad suite of services now, installation remains their absolute bread and butter. It accounted for approximately 60% of their $2.8 billion in net revenue in fiscal year 2023.
60%. Still the core.
Definitely. And they work with a comprehensive range of materials too, from traditional fiberglass to spray foam and cellulose, ensuring they can meet diverse construction needs and comply with various energy efficiency standards.
Okay.
But here's the crucial insight about their strategy. Over time, IBP has significantly diversified its offerings into a wide array of complementary building products.
Right.
This isn't just about insulation anymore. It includes things like waterproofing, fire-stopping, fireproofing, garage doors, rain gutters, window blinds, shower doors, closet shelving, even mirrors.
Wow, quite a list.
Yeah. And what's fascinating here, and maybe a bit counterintuitive, is that this diversification isn't primarily aimed at making the company less susceptible to the cyclical nature of the housing market.
Wait, really? So it's not about smoothing out the ups and downs of new home builds.
Yeah.
That seems like the obvious reason a construction company would diversify.
Exactly. You'd think so, right? But instead, it's laser focused on increasing the revenue generated per housing start.
Ah, okay.
For every new home built, IBP wants to capture a larger share of that builder's budget. They're trying to be a one-stop shop for a wider range of installed products within that single new construction project.
So whether the market's hot or slowing down, they want more dollars from each house that does get built.
That's the idea. Maximize the value they extract from each individual project.
That's a really smart angle.
Yeah.
So who are their main customers then, and how does that revenue actually break down given the strategy? Where's the money coming from?
Right. Looking at their revenue segmentation for fiscal year 2024, you get a really clear picture of their dependency. Their revenue is overwhelmingly concentrated in new residential construction.
Okay.
That segment alone accounted for a massive 72.3% of their total net revenue. We're talking over $2.1 billion annually.
72%. Huge.
It really is. Commercial projects are a distant second, contributing about 15.7% or around $460 million.
Still significant, but yeah, dwarfed by residential.
Definitely. Now, the repair and remodel segment, which, you might think would offer some counter-cyclical stability during a housing downturn.
Right. People fix up existing homes when they don't buy new ones.
Exactly. But it's surprisingly small for IBP at just 5.9% of revenue, about $174 million. There's also an other segment covering some manufacturing and distribution, making up about 6.1%.
Yeah.
So out of a total net revenue of just over $2.9 billion in 2024, their installation segment is incredibly dominant, generating a remarkable 94% of that total revenue.
Wow, 94% installation. So to connect this to the bigger picture, they are deeply, deeply tied to the health of the new home building market. Full stop.
Absolutely. And their geographic reach is crucial for serving those national builders, right?
Makes sense. They need coverage.
Yeah, their extensive geographic footprint is key to this model. They operate a national network of over 250 branch locations across all 48 continental states and the District of Columbia.
250 branches. That's quite a network.
It is. And this vast presence allows them to serve large national home builders effectively because these builders often operate across multiple states and, frankly, they prefer to work with consistent partners.
Yeah, easier than finding a new installer in every single market.
Exactly. It's much easier for a builder to work with one company that can handle installations everywhere than, dozens of local specialists.
Okay, here's where it gets particularly insightful, I think, about how they've managed to grow so rapidly. Their operational structure is defined by what they call a national platform local execution model.
Yeah.
How does that work? And what's the strategic trade-off they're making there?
Right. This model is actually a classic roll-up strategy. You see this in fragmented industries. A company systematically acquires smaller players to consolidate the market, gain scale, market share.
Okay, buying up the little guys.
Essentially, yeah. When IBP acquires a local or regional installer, they don't swoop in and completely overhaul everything. Instead, they actually encourage the acquired company to retain its existing leadership, its employees, even its operational processes.
Really, keep the local team in place.
Yeah. And then IBP provides the benefits of its national scale. Things like enhanced purchasing power on materials, access to capital for growth, and robust back office support like HR, accounting, IT.
That founder-friendly approach sounds great for getting deals done.
Yeah.
People probably like selling to them but I'm curious, does that ever hinder their ability to standardize operations or, truly squeeze out efficiencies across 250 diverse branches that were run independently before? It feels like a big trade-off.
It absolutely is a significant strategic trade-off. You hit the nail on the head. By preserving that local identity and management, they gain on the acquisition front.
Right.
However, this light-touch integration model may limit the kind of deep, systemic, operational synergies you often find in a full top-down integration.
Like standardizing everything.
Exactly. Standardizing labor management practices, IT systems, maybe even fleet management across 250 diverse, previously independent branches. That can be much harder with this approach.
Makes sense.
Our source highlights that the primary synergy IBP achieves with this model is centralized material procurement, getting better prices because they buy so much.
Okay, so mostly purchasing power.
Largely. So it raises an important question for you, the listener. Does the value created by this higher acquisition velocity, meaning they can acquire more companies faster, outweigh the potential margin expansion that might come from a more rigorous top-down integration that could squeeze out even more operational efficiencies? It's a fascinating balance they strike.
Yeah, growth speed versus maybe deeper integration benefits. That's a really compelling strategic tension. Okay, let's pivot now and look at the broader environment IBP operates in.
Right.
How are the U.S. construction industry and macroeconomic conditions impacting a business so tied to housing?
Indeed. The U.S. construction industry, after enjoying several years of pretty robust expansion, is now entering a phase of, let's say, moderated growth.
Slowing down a bit.
Yeah. Forecasts for 2025 project overall construction spending to increase by a modest 1.4% to 2.2%. This deceleration reflects economic headwinds like, higher interest rates, which make borrowing more expensive for everyone.
Developers, home buyers.
Right. And persistent inflation, which erodes purchasing power, and increases project costs. These factors are really slowing down the pace of expansion across the board.
Okay, let's unpack the residential market specifically, which we know is so crucial for IBP. Our sources say it's actually showing a notable bifurcation, like two very different trends playing out simultaneously.
Exactly. Bifurcation is a great word for it. On one hand, single-family housing is actually showing some signs of recovery.
Oh, interesting. Why is that?
Well, factors like stabilizing, though still elevated, interest rates are providing maybe a clearer picture for potential buyers. Some housing policy reforms are starting to emerge. And crucially, there's also this fundamental long-term undersupply of U.S. housing.
Right, the structural shortage we hear about.
Exactly. That provides a strong foundational support for new construction activity in this segment. People simply need places to live, and we haven't built enough single-family homes for a while.
Okay, so single-family recovering. What's the other side of the coin?
In stark contrast, the multifamily housing segment, think apartment buildings, is facing a significant slump.
Why the slump there?
Well, there was a period of pretty aggressive construction that has led to overbuilding in many markets.
Too many apartments built too fast.
Kind of. This has resulted in higher vacancy rates and understandably downward pressure on rents. Combine that with tighter financing conditions for developers building these big projects, and you see a contraction in multifamily starts. That slowdown is expected to persist through 2025. It's a tough environment for large apartment complexes right now.
So this creates a really complex operating environment for IBP, doesn't it? The multifamily downturn is a direct headwind for a portion of their business.
Definitely.
But the single-family recovery offers a partial offset. Is there a more subtle implication here regarding, say, labor? You mentioned labor shortages earlier.
That's a perceptive observation. What's fascinating here is the interplay with the industry's severe labor shortage. Single-family construction is typically more geographically dispersed and more labor-intensive per unit compared to large, concentrated multifamily projects.
Right, building one house here, one house there versus one big apartment block.
Exactly. So a market-wide shift in the construction mix from multifamily back towards single-family could therefore exacerbate the strain on the available pool of skilled labor. It could intensify wage pressures across the industry.
Oh, interesting.
And this makes IBP's strategy of acquiring existing staffed installation crews even more valuable. They aren't just buying revenue, they are essentially buying pre-existing labor capacity in a super tight market. It shifts their M&A focus slightly from simply buying revenue to effectively acquiring a scarce resource, skilled labor.
That's a powerful insight. Okay, what about commercial construction? Does that offer much stability or growth for IBP, given it's about 15% of the revenue?
Well, the outlook for the commercial construction market is mixed and generally pretty subdued. Projections indicate modest growth, maybe 1.7% in 2025, potentially accelerating a bit to 4.2% in 2026.
So not huge growth there.
No, and growth here is highly sector dependent. For instance, data center construction is a major bright spot. Huge demand there.
Right. Cloud computing, AI.
Exactly. But traditional sectors like office and retail continue to face significant headwinds from that structural shift to remote and hybrid work models. We're still seeing the lingering effects of that.
Yeah, empty office buildings.
Right. On the more positive side, institutional sectors, including healthcare and education facilities, are expected to see stronger gains within the non-residential building category. So it's a mixed bag.
Okay. Beyond these broad market trends, what specific dynamics within the installation industry itself are critical for IBP?
Well, as we mentioned, the market itself is highly fragmented. You have the two large public players, IBP and TopBuild, but then literally thousands of small, privately owned local and regional contractors.
Really?
And this fragmentation is precisely what provides such a long runway for IBP's consolidation strategy. It gives them this vast pool of potential acquisition targets.
Makes sense. What else?
However, the most significant operational headwind for the entire construction industry, and therefore for installers like IBP, is that chronic and severe shortage of skilled labor.
Still the big one.
Yeah, it really is. We're talking about an aging workforce. Over 40% of construction workers expected to retire by 2030. A 2024 survey found an overwhelming 94% of firms were struggling to fill open positions.
94%. That's almost everyone.
It's huge.
Yeah.
And this shortage directly impacts companies like IBP by increasing labor costs, extending project timelines, and acting as a practical constraint on their organic growth capacity. It's a very real challenge.
Yeah, and seasonality.
Oh, yeah. And on top of that, the business is naturally seasonal. Activity is typically lower in the first quarter due to colder weather in many parts of the country, and then higher during the peak building seasons of Q2 and Q3.
Makes sense. Okay, what about external factors like regulations and technology? Are those impacting IBP's business model in significant ways?
Absolutely. Building energy codes are a powerful, long-term secular tailwind for the insulation industry.
A tailwind. How so?
Well, regulations like the International Energy Conservation Code, or IECC, which gets updated every 3 years, continually mandate higher levels of energy efficiency in new construction.
Stricter rules mean more insulation.
Essentially, yes. For IBP, this translates directly into higher demand for insulation products, meaning greater thickness or higher R value per installation, and also more sophisticated air sealing services.
Okay.
This regulatory driver provides a consistent, non-cyclical source of growth in revenue per job. It means that even if the volume of new homes slows down, IBP can still potentially generate more revenue from each project because the energy requirements are getting stricter.
So that helps buffer downturns and amplify upturns.
Exactly. It can provide a partial offset during downturns and amplify growth during upswings. It's a nice underlying trend for them.
And technology. Is insulation getting disrupted?
Well, the core of insulation installation remains a pretty labor-intensive process, but several technological trends could impact the industry over the long term. Innovations in advanced materials like aerogels or vacuum insulation panels offer superior thermal resistance, but they're still pretty expensive right now.
Okay.
The rise of off-site and prefabricated construction methods could eventually shift some installation work from the traditional job site into a factory setting.
Right, building houses and factories.
Yeah. And furthermore, smart insulation technologies, things like topology morphing systems that can dynamically alter their thermal properties. They're in really early stages of development, but represent a potential future disruption.
Wow, smart insulation.
Yeah. For now, though, these technologies pose a pretty low near-term threat to IBP's existing business model, but they definitely warrant monitoring as potential long-term industry shifts that could change the game down the road.
Okay, that gives us a good sense of the market dynamics. Now, how does IBP actually stack up against its competitors? What gives it an edge in this fragmented market, especially against its largest rival?
Right. Well, IBP has truly established itself as the second largest installer of insulation in the U.S. new residential construction market. Their growth in market share has been quite impressive.
How impressive?
At its IPO back in 2014, they held an estimated 16% share. Today, largely through that aggressive acquisition strategy, they've expanded that to approximately 30%.
16 to 30%. That's nearly double.
It is. But the key takeaway here is subtle, but I think vital. IBP's market dominance isn't necessarily built on being the best local installer everywhere.
Oh.
It seems to be built more on being the best acquirer. Their real competitive advantage lies more in their corporate finance muscle and their M&A function, not necessarily their on-the-ground operational superiority in every single one of those 250 branches.
That's a critical distinction. So their edge is strategic and financial, maybe more than operational at the local level.
Yeah.
How do they compare then to TopBuild, which I believe is the market leader? Are they basically clones, or do they approach the market differently?
That's a great question, because TopBuild Corp, ticker BLD, is indeed the market leader in U.S. installation and distribution. And a comparative analysis reveals some really critical differences.
Okay, let's hear them.
Just to give you a snapshot, TopBuild is roughly twice IBP's size in both market capitalization and revenue. So IBP has a market cap around $5.6 billion. TopBuild's closer to $10.7 billion. Revenue-wise, IBP's around $2.9 billion TTM. TopBuild's about $5.3 billion.
So TopBuild is the bigger player significantly.
Definitely. When it comes to profitability, though, it's a bit nuanced. IBP actually shows a slightly higher gross margin, around 33.5% compared to TopBuild's 30.3%.
That's interesting. Why is that?
Could be product mix, purchasing. But TopBuild consistently pulls ahead on overall operating and net profit margins. IBP's operating margin is about 12.7% versus TopBuild's 16.9%. And net margin for IBP is 8.4% compared to TopBuild's 11.2%.
So TopBuild is ultimately more profitable on the bottom line, despite a slightly lower gross margin, maybe more efficient overall.
It suggests that, yeah, maybe greater operational efficiency at scale, or perhaps they benefit more from their diversified business model, which we should touch on.
Okay. And what about their financial leverage and how the market values them? Any differences there?
Big differences here. IBP exhibits a remarkably higher return on equity, or ROE. It ranges from 36.7% up to 60.7% depending on the period, compared to top build's 24.6% to 28.5%.
Wow, IBP's ROE is much higher. Why?
Well, this outperformance in ROE for IBP is largely a function of its more aggressive use of financial leverage. Remember, we talked about debt. IBP has a debt-to-equity ratio of 1.48x, which is roughly double top build's 0.74x.
So more debt is boosting that ROE figure.
Exactly. It amplifies the returns on shareholder equity. Now, in terms of valuation multiples, the market consistently assigns IBP a higher valuation. Its trailing 12-month PE ratio is around 23.3x, higher than top build's 19.2x. Similarly, IBP's EV/EBITDA ratio is higher than top build's.
So the market pays more for IBP's earnings and EBITDA, even though it's smaller and maybe less efficient overall than top build. Why the premium?
Well, the analysis of these differences reveals a few things. First, their business models are structurally different. IBP, as we said, is predominantly installation-focused, 94%.
Right.
Top Build, however, has two large, distinct segments. True Team, which is its installation arm, similar to IBP, and Service Partners. Service Partners is a major wholesale distributor of insulation and other building materials to a wide range of contractors, including IBP's smaller competitors.
Yo, wait. So Top Build sells materials to IBP's competition.
Yep. This vertical integration gives Top Build a more diversified revenue stream. They make money installing, and they make money distributing materials to others, including rivals of their own installation arm.
That distribution business for Top Build, does that offer a different kind of resilience during, say, a housing downturn compared to IBP's pure installation focus?
That's precisely the implication, and it's a really important structural difference. Top Build's large distribution business may offer superior resilience during a housing downturn.
How so?
Well, while installation demand might fall across the board, Top Build can still generate revenue and profit by selling materials to the broader market of smaller contractors who continue to operate, perhaps doing more repair and remodel work, for example.
Okay, so they still make money, even if their own installation crews are less busy.
Exactly. IBP's revenue, being much more directly tied to its own installation labor capacity and new construction projects, could prove more volatile and more sensitive to swings in new construction starts.
That's a really key difference in how they might weather a storm. Okay, so with all that in mind, what gives IBP a real, defensible, competitive moat? Something that truly sets it apart and protects it from rivals, including Top Build or those thousands of small guys.
IBP's competitive advantages, or its moat, seem derived from several key sources. First, its sheer scale provides significant purchasing power. As one of the largest buyers of insulation in the country, IBP can procure materials from the big manufacturers at more favorable terms than smaller, independent contractors can.
Better pricing on materials.
Yeah, and that's a significant advantage, particularly in an industry where material costs are a major chunk of the overall cost of goods sold. Second, their national customer relationships are a big plus.
Serving the big builders everywhere.
Right. Their extensive national footprint allows them to effectively serve those large national home builders who need consistent service and quality across multiple geographic markets. IBP can provide that in a way smaller, regional players simply cannot.
Makes sense. Easier for the builder.
And finally, perhaps its most durable competitive advantage is that well-established M&A platform we talked about.
Being the best acquirer.
Exactly. IBP has a dedicated team and a proven, repeatable process for identifying, acquiring, and integrating smaller installers. Its reputation as that founder-friendly buyer that preserves local autonomy makes it an acquirer of choice.
So they get first look or better terms on deals sometimes?
Potentially, yeah. It creates this self-reinforcing pipeline of deals, as independent owners might be more willing to sell to IBP, knowing their legacy and employees will be handled with care. This is truly a corporate-level advantage rather than an advantage based on, say, a superior local installation service, which, frankly, can often be more commoditized. It's really about their ability to grow strategically through consolidation.
Okay, that clarifies their strategic edge really well. Now let's talk numbers. How has IBP translated this strategy into financial results? What do the financials tell us about their performance over time?
Right, the proof is in the pudding, as they say. Over the past 7 years, IBP has delivered a pretty impressive trajectory of growth in both revenue and profitability.
Like what kind of numbers are we talking?
Their net revenue has scaled up significantly. It grew from about $1.34 billion back in 2018 to nearly $3 billion, specifically $2.94 billion in 2024.
Wow, more than doubled in 6 years.
Yeah, that's a compound annual growth rate, or a CAGR, of approximately 14% over that period. And this top-line expansion has been accompanied by a notable improvement in profitability, too. Their operating margins have improved from 7.0% in 2018 to over 12% in 2023 and 2024.
Better margins, too.
Yeah, gross margin has steadily improved from 27.8% in 2018 to 33.4% in 2024. Even their diluted earnings per share, or EPS, has grown impressively from $1.76 in 2018 to $8.77 in 2024.
Okay, that's significant growth across the board.
Yeah.
And it's absolutely crucial to dissect the sources of this growth because it really defines their investment thesis, right? IBP provides a metric called same branch sales in its quarterly reports.
Okay, what does that show? It's a really useful proxy for organic growth because it excludes the impact of acquisitions made in the last 12 months. And when you look at this metric, it becomes quite clear that the majority of IBP's reported growth is, in fact, inorganic.
So, mostly buying growth.
Pretty much. For fiscal year 2024, for example, their total net revenue growth was 5.9%. Okay, respectable. However, their same branch net revenue growth was only 3.5%.
So the difference, 2.4%, came directly from acquisitions made that year.
Exactly. And this persistent and significant gap between total revenue growth and same branch sales growth really underscores the company's fundamental reliance on its M&A strategy. The underlying organic growth of the actual existing business is often pretty modest, in the low to mid-single digits usually.
And probably more volatile, tied to the housing cycle.
Lightly susceptible to the fluctuations of the construction cycle, yeah. We saw this starkly in the first quarter of 2025. Their same branch performance was actually negative 4.2%, but their total revenue growth was only down 1.2%.
Because acquisitions offset some of that organic decline.
Right. Acquisitions added 3.0% in that quarter, cushioning the blow. This indicates that without that continuous fuel of acquisitions, IBP's growth profile would be substantially lower and much more volatile.
So the investment thesis here isn't really about some amazing organic growth story.
Less about the organic expansion of a superior installation service and far more about the financial and strategic execution of a market consolidation play. It's a roll-up story.
That makes a lot of sense. So what about their profit margins? You said they improved. How sustainable are those improvements, especially if the housing market shifts or competition heats up?
Right. IBP has indeed successfully expanded its profit margins over the past several years. Gross margin, for instance, improved from 27.8% in 2018 to over 33% in both 2023 and 2024. Operating margins followed a similar upward trajectory.
What drove that? Better purchasing?
Yeah.
Pricing power?
It's likely a combination of factors. Increased scale leading to better purchasing power on materials, certainly. A favorable pricing environment driven by strong housing demand and maybe some inflation pass-through, and potentially an improved mix of higher margin products and services as they diversified.
Okay, but the key question for you as a listener and for investors is the sustainability of these margin levels, right?
Exactly. This recent period of margin expansion coincided with a very strong housing market and significant inflation in building material costs, which, frankly, may have provided some cover for price increases across the industry.
Easier to raise prices when everything's going up.
Right. As the housing market moderates and material cost inflation potentially abates, the company's ability to maintain that pricing discipline will be thoroughly tested. A potential bear case scenario involves margin compression as volumes soften and competitive pricing pressures intensify, particularly during a housing downturn. This is definitely a key watch point.
Got it. And how are they managing their cash? Does this highly acquisitive model chew up a lot of capital, or are they quite efficient cash generators?
Actually, a key strength of IBP's financial model is its strong cash flow generation and relatively low capital intensity.
Low capital intensity. For an installation business.
Yeah, the installation business inherently has minimal capital expenditure requirements. Primarily, they just need investments for their fleet of trucks and the installation equipment itself. There aren't big factories or anything.
Right, mostly vehicles and tools.
Exactly. This allows for a very high conversion of EBITDA, that's earnings before interest, taxes, depreciation, and amortization, into actual free cash flow.
Okay, so they generate a lot of cash from operations.
They do. They've consistently generated robust cash flow from operations, and this has been the primary funding source for both their ongoing acquisitions and their shareholder returns. As of March 31st, 2025, they maintained a healthy liquidity position with nearly $300 million in cash and cash equivalents and a current ratio of 2.89.
What does that ratio mean?
It basically indicates strong short-term financial health meaning they have plenty of current assets to cover their short-term liabilities, which is crucial for a company that relies on having cash ready for strategic capital deployment, like buying another company.
Okay, strong cash flow, good liquidity. Now, let's turn our attention specifically to how they fuel this growth engine. How does IBP plan to keep this acquisition machine running, and how do they actually manage their money, their capital allocation?
Right. IBP's corporate strategy is very explicitly defined by its approach to growth and capital allocation, and it's truly centered on that disciplined, acquisition-led consolidation. Acquisitions are the cornerstone.
Number one priority.
Absolutely. Management consistently designates them as the top priority for capital deployment. They have this robust, repeatable process for identifying, acquiring, and integrating those small, privately held installers, leveraging the highly fragmented nature of the industry to continuously fill their pipeline.
And their track record is pretty extensive, right?
Oh, yeah. Since 1999, IBP has completed and successfully integrated over 190 acquisitions.
Wow. Over 190.
Yeah. And in more recent years, the pace has been quite consistent. In 2023, they completed 8 acquisitions, adding about $75 million in annual revenue. In 2024, they actually picked up the pace a bit, completing 9 acquisitions, adding over $100 million in annual revenue.
And they guide for that level of activity.
They do. Management provides clear forward guidance for their M&A activity, consistently targeting to acquire at least $100 million in annual revenue per year. This gives investors a degree of predictability for that inorganic growth component of the company's top-line performance. And they continually report that their acquisition pipeline remains strong, with opportunities across multiple geographies, products, and markets.
Why powerful, this strategy isn't without risk, as we touched on. As IBP gets bigger and bigger, does it face pressure to make more or perhaps larger acquisitions just to maintain the same percentage growth rate? Does the roll-up get harder?
You've hit on a critical point. While this strategy is undoubtedly a powerful growth engine, it isn't without risk. As IBP increases in scale, it must execute more acquisitions or larger acquisitions simply to maintain the same percentage growth rate. A $100 million acquisition moves the needle less for a $3 billion company than it did for a $1 billion company.
All right. The law of large numbers.
Exactly. This creates continuous pressure to deploy capital, which could potentially lead to a relaxation of acquisition criteria or maybe even overpaying for assets, especially as competition for the most attractive targets in the fragmented market might intensify over time. This is a critical risk to monitor within their growth strategy. Are they maintaining discipline as they get bigger?
That makes sense. So, given their strong cash flow and this intense focus on M&A, how do they decide where to put all this capital? What's their hierarchy for using cash?
IBP's management adheres to a very clear and disciplined capital allocation hierarchy. After funding the basic operational needs of the business, their capital is prioritized in 3 key areas. First, number 1, accretive acquisitions. That's the primary use of capital.
Okay.
Second, they prioritize shareholder returns through consistent and growing dividends. And third, they engage in opportunistic share repurchases, buying back company stock when management perceives it to be undervalued.
So acquisitions first, then dividends, then buybacks.
That's the stated order. If we look at some illustrative capital deployment estimates for 2024, you can see how this plays out. They spent over $100 million on acquisitions, paid out approximately $100 million in cash for dividends, and spent around $130 million on share repurchases.
Interesting. Buybacks were actually slightly higher than dividends and acquisitions that year.
Yeah, it shows flexibility. Total capital deployed was about $330 million for that year alone. Now, a unique feature of their shareholder return policy is a dual dividend structure.
Dual dividend. How does that work?
They pay a regular quarterly cash dividend, providing stability. And then they pay an annual variable dividend on top of that.
Variable based on profits.
Exactly. This approach provides stability with the regular payment while offering the flexibility to return a larger portion of their profits in strong years through the variable component without committing to an unsustainably high fixed payout year after year.
Smart way to share upside without getting locked in.
Right. And management has consistently increased both dividends, signaling confidence in the company's financial position and cash flow generation. They also have an active share repurchase program. A new $500 million program was authorized in early 2025, replacing a previous one. In 2024 alone, they returned a combined $230 million to shareholders through dividends and buybacks, which shows a significant commitment to this part of their capital allocation strategy.
Okay. And how does debt play into this picture? You mentioned their leverage is higher. Is their acquisition-led growth heavily reliant on borrowing?
Yes, IBP explicitly utilizes debt to help finance its acquisition strategy. As of the first quarter of 2025, they had approximately $977 million in total debt, and their total debt-to-equity ratio was 1.48x.
Nearly 1.5 times debt to equity.
Yeah. Management has demonstrated a proactive approach to managing this debt profile, though. They repriced their term Loan B facility in late 2024 to reduce annual interest costs and extend maturities, so they are actively managing it.
But the leverage is still a key part of the model.
It is. While this leverage is a key component of the company's financial model and enables their rapid acquisition pace, it also introduces financial risk. Their credit facilities contain restrictive covenants.
Covenants, like rules from the lenders.
Exactly. Think of them as financial rules or conditions set by the lenders. If IBP's financial performance dips, these covenants could restrict their ability to borrow more money, make new acquisitions, or even pay dividends. It adds a layer of risk, especially during an economic downturn. So it's that double-edged sword again. Debt fuels growth, but also adds risk and constraints.
Got it. Okay, for a company driven by such a specific and complex M&A strategy, the quality and the vision of the management team seem absolutely crucial. How does IBP's leadership stack up, especially given their particular growth model?
That's a great point. Insult Building Products is led by Chairman and CEO Jeff Edwards, and the leadership team, by all accounts in our sources, has demonstrated a very consistent and disciplined approach to both strategy and operations for many years.
Consistency is good.
Yeah. Their core strategy growth through acquisition, product diversification, strong focus on shareholder returns has been clearly and repeatedly articulated in their public communications, earnings calls, investor days.
Stick to the script.
Pretty much. And this consistency in messaging, coupled with a strong track record of actually executing on stated goals, lends significant credibility to the management team. For example, that recurring guidance to acquire at least $100 million in annual revenue has been consistently met or even exceeded. That provides a level of predictability that investors tend to value.
Okay, they seem credible and consistent. But how aligned are the leadership's interests with those of the shareholders? Is their compensation tied to long-term value creation? Or is there any risk that they're incentivized just to do deals regardless of quality?
Right. That's the key question on alignment. It's primarily evaluated through the executive compensation structure and the levels of insider ownership. While a full analysis of their comp tables would require digging into their annual proxy statement,
Which we don't have time for here.
exactly, but the ideal structure would tie a significant portion of executive compensation to metrics that truly drive long-term value. You'd want to see things like return on invested capital, ROIC, maybe organic or same-branch sales growth, and certainly earnings per share growth.
Metrics that show efficient use of capital and real underlying growth.
Right. What you ideally want to see is a structure that avoids too heavy a weighting towards metrics that can be easily inflated through acquisitions alone, like just total revenue growth or maybe adjusted EBITDA, without considering the underlying capital efficiency or the organic health of the business.
Makes sense. What about insider activity? Are execs buying or selling?
Recent insider transaction data for IBP shows a bit of a mixed bag, both selling and buying activity. On the positive side, the CFO recently purchased approximately $454,000 worth of stock in May 2025.
Okay, CFO buying is usually seen as a good sign.
Generally, yes. It's a positive signal of confidence from someone deeply familiar with the company's financials. However, our sources also note that there has been some insider selling activity over the past year as well.
Which could mean anything, really.
Exactly. People sell for many reasons. Ultimately, though, significant insider ownership by the executive team and the board provides a very strong indication of alignment with common shareholders, as their personal wealth is directly tied to the company's long-term performance. You'd want to check the exact ownership levels in the proxy.
Okay, so management seems consistent, alignment needs a deeper look, but isn't flashing major red flags. Now let's talk risk. Every investment carries risk. What are the key vulnerabilities for IBP, the things that could really go wrong in their business model, especially with that heavy reliance on acquisitions and the housing market?
Right. An investment in IBP definitely carries a number of risks inherent to its business model and the industry it operates in. We can kind of categorize these into cyclical, operational, and financial risks.
Okay, let's start with cyclical. Housing dependence seems like the big one.
It is. Starting with cyclical and macroeconomic risks, the single most significant risk facing IBP is its direct and substantial exposure to the cyclicality of the U.S. housing market. with roughly 72% of its revenue derived directly from residential new construction.
72%.
A downturn in housing starts would have a direct and material negative impact on the company's sales volumes, its pricing power, and critically, its profitability. It's just unavoidable.
And interest rates feed into that directly.
Absolutely. Related to this is interest rate sensitivity. Housing affordability is a key driver of demand for near homes, and elevated or rising interest rates increase mortgage costs for home buyers. This can significantly dampen demand for new construction and, in turn, reduce the demand for IBP's installation services.
Makes buying a new house harder.
Yep. Furthermore, broader economic weakness, like a recession leading to higher unemployment, can reduce consumer confidence in household formation, further pressuring the housing market and IBP's end markets. So they're very exposed to the macro cycle.
Okay, those are the big cyclical risks. What about operational or execution risks? Things within their control, sort of.
Right. Moving to operational and execution risks, the company's growth, as we've hammered home, is heavily dependent on its ability to successfully acquire and integrate a large number of disparate businesses.
The integration piece is key.
It really is. A failure to effectively integrate an acquisition could lead to operational disruptions, maybe culture clashes between the acquired company and IBP, loss of key personnel who decide to leave after the deal, and an inability to realize the expected synergies like cost savings or revenue growth.
And a really bad acquisition could be disastrous.
A significant misstep in a large acquisition could potentially result in material goodwill impairments, basically writing off the value of the acquired company, and that could truly be destructive to shareholder value. So M&A execution risk is very real.
And what about that labor shortage we talked about earlier? Is that a big operational hurdle for them day to day?
Absolutely. The chronic shortage of skilled labor in the construction trades is another major operational risk. This shortage acts as a practical constraint on their organic growth. They can only do so much work with the people they have, and it puts upward pressure on wages, which can compress profit margins.
Harder to grow and potentially less profitable growth.
Exactly. The inability to attract and retain a sufficient number of qualified installers is a primary threat to the company's capacity to meet demand, regardless of how many acquisitions they make on paper. You need the bodies to do the work.
Makes sense. Any other big operational risks?
Supply chain.
Yeah, supply chain and material costs. IBP relies on a relatively concentrated number of manufacturers for its primary insulation materials.
Like Owens Corning, Johns Manville.
Right. Any disruption in this supply chain, whether due to manufacturing issues at those suppliers, transportation bottlenecks, or even changes in trade policy, could lead to material shortages and project delays for IBP. Plus, the company is exposed to price volatility for its key inputs. An inability to fully pass on material cost inflation to customers could negatively impact their gross margins.
Okay, so cyclical, operational. What about financial risks beyond just the cyclical impact? You mentioned debt. Right. From a financial risk perspective, IBP utilizes that significant amount of debt to finance its acquisition strategy. As of Q1 2025, its debt-to-equity ratio was 1.48x. This level of leverage increases financial risk inherently. And, as we mentioned, the company's credit facilities contain those restrictive covenants.
The lender rules.
Yeah. These could limit its ability to incur additional debt, make further investments, or even pay dividends in the future, particularly if financial performance deteriorates significantly, like in a deep recession. So the debt adds constraints.
So when you connect all these risks to the bigger picture, what are the absolute most significant ones that investors need to keep front of mind for IBP?
When we connect this to the bigger picture, I think the two most significant risks for IBP, that housing cyclicality and the acquisition integration risk, are deeply intertwined.
How so?
Well, think about it. A severe housing downturn would not only reduce revenue and operating cash flow directly, but it could also strain the company's ability to service the debt it has taken on to fund all that growth through acquisitions.
Right. Less cash coming in to pay interest and principal.
Exactly. Furthermore, a downturn could expose operational weaknesses in previously acquired companies that might have been masked by a strong market environment. Maybe they overpaid, maybe the integration wasn't as good as they thought.
And that could lead to write-downs.
Potentially, yeah, leading to goodwill write-downs and revealing that those assets were acquired at peak valuations. The resilience of this highly acquisitive business model through a prolonged and severe housing recession remains a key uncertainty, mainly because we haven't really seen them tested in their current large public form through a truly deep and extended downturn, like, say, 2008, 2009.
That's a really important point about testing the model. Okay, Given all these factors, their growth strategy, their financials, these inherent risks, how should we think about IBP's valuation? Is it priced for perfection? Is it cheap? How does it look?
Right, valuation. It has to be considered in the context of its historical trading ranges, its relationship to its primary peer, top build, and crucially, the inherently cyclical nature of its end markets.
Can't ignore the cycle.
Definitely not. If we look at historical multiples analysis, the company's trailing 12-month, or TTM, price-to-earnings PE ratio currently stands at approximately 23.3x.
23 times earnings. How does that compare historically?
Historically, this multiple has fluctuated quite widely. It went from a low of around 11.0x during the market trough in late 2022, up to a peak of 58.4x way back in late 2017.
Wow, big range.
Yeah. The 10-year average PE ratio for the stock is about 28.02, so the current valuation around 23x is actually below its long-term historical average, though it's still well above those cyclical lows we saw in late 2022.
Okay, what about other metrics, like EBITDA?
Yeah, another important metric is the enterprise value to EBITDA ratio. The current TTM EBITDA for IBP is in the range of about 12.1x to 13.2x. This metric, remember, accounts for debt in the capital structure, so it's often preferred for comparing companies with different levels of leverage, like IBP and TopBuild. It gives a more complete picture of the company's total value relative to its operating earnings.
Okay, so around 12, 13 times EBITDA. How does that valuation compare specifically to its closest competitor, TopBuild? Is the market valuing them similarly, or is there that noticeable premium or discount we talked about?
Right, the pure comparison is key. IBP consistently trades at a valuation premium to TopBuild. IBP's TTM PE ratio of roughly 23.3x is notably higher than TopBuild's approximately 19.2x.
Like a clear premium on PE.
Yep. And similarly, IBP's EBITDA multiple of 12-13x is higher than TopBuild's, which is around 10.5x.
So a premium on both metrics. Why does the market consistently pay more for IBP?
Well, this persistent valuation premium is a critical point to understand. It suggests the market is placing a higher value on certain attributes of IBP's business model and financial profile. The most likely drivers of this premium seem to be IBP's more aggressive growth by acquisition strategy.
The roll-up story itself.
Exactly. And its significantly higher return on equity, which, as we discussed, is amplified by its greater use of financial leverage. Investors appear willing to pay a higher multiple for IBP's demonstrated ability to rapidly consolidate the industry and deploy capital, thereby accepting a higher risk profile, more debt, more integration risk in exchange for a higher perceived growth rate and that higher return on equity.
So the valuation is really tied to the M&A story continuing successfully.
It implies that, yes, IBP's valuation is likely highly sensitive to the continuation of its M&A strategy. Any slowdown in acquisition activity or a significant integration failure could put this premium valuation at risk pretty quickly.
That raises a really important question for anyone trying to model this company or figure out its intrinsic value. What are the key assumptions that would truly drive a valuation for IBP if someone were to build a detailed financial model, like a DCF?
That's a great question. And while we aren't building a full discounted cash flow model here on the air,
Probably for the best.
right, it's vital to consider the key assumptions that would drive such a valuation. The intrinsic value of IBP is highly sensitive to probably three main variables. First, the long-term forecast for U.S. housing starts over the next decade.
Got to get the housing market right.
It's the single most important top-line driver because their business is so heavily tied to new construction volume. Second, the assumption around their through-cycle profit margins.
Can they keep those high margins?
Exactly. The ability of the company to sustain its current high single-digit net profit margins through a full economic cycle is a crucial assumption. A reversion back down to lower historical margin levels would significantly reduce projected free cash flows in any model.
Okay. And the third?
And third, the terminal growth rate. This is the assumed long-term growth rate beyond the explicit forecast period in a DCF. It needs to accurately reflect the eventual maturation of their roll-up strategy. They can't buy companies forever, and a normalized rate of economic and construction industry growth once that rapid acquisition phase inevitably slows down. Getting that terminal growth rate right is always tricky, but especially for a roll-up.
Makes sense. Those three seem critical.
And given the inherent cyclicality of the business, Probably the most prudent way to approach valuation would be using a cyclically adjusted methodology.
How does that work?
It basically involves normalizing earnings or cash flows over a full housing cycle, averaging the peaks and troughs to get a sense of sustainable earning power, and then applying a multiple to that normalized figure. It helps you see past the immediate ups and downs.
Right. Avoid getting too excited at the peak or too depressed at the bottom.
Exactly. It helps determine a more rational, long-term fair value range for IBP.
Okay, let's try to synthesize everything we've unpacked now. We've covered a lot of ground. What's the core debate or tension in the investment profile for IBP? What's the main thing people argue about?
I think the core debate revolves fundamentally around the durability of its growth model, that M&A engine, versus its inherent cyclical vulnerabilities. It's really a balance, or maybe a tension, between its clear strategic strengths in consolidation and its undeniable exposure to the broader housing economy.
Growth engine versus cyclical risk. Got it. So what are the strong arguments, the bull case, for investing in IBP? Why might someone be optimistic?
Right. The optimistic view, or the bull case for IBP, centers on several key pillars. First, it's a proven consolidator in a very fragmented market. IBP has that well-honed M&A engine and still a very long runway for continued growth by acquiring those numerous smaller regional installers. Its reputation as a founder-friendly and preferred buyer provides a durable competitive advantage in sourcing deals, which is crucial fuel for a roll-up strategy.
So the M&A story has legs. What else?
Second, there are those secular tailwinds from energy efficiency. Progressively stricter building energy codes provide a non-cyclical driver for growth in revenue per job. As insulation and air sealing requirements increase, IBP can generate more revenue from each housing start, providing that partial buffer against downturns in volume and amplifying growth during upswings. It's a nice underlying current.
Okay, M&A runway, energy codes,
Mm-hmm.
anything else?
Third, the company benefits from favorable long-term housing fundamentals in the U.S. Despite the near-term cyclicality we've discussed, the country continues to face a structural undersupply of housing. This fundamental imbalance should provide a supportive backdrop for residential new construction demand over the long term, offering a base level of activity for IBP to work from.
So the long-term need for houses helps.
Yeah. And finally, management has demonstrated discipline and shareholder-friendly capital allocation. They have a clear and effective strategy for deploying capital, balancing reinvestment in accretive M&A with significant and growing returns to shareholders through their dual dividend policy and share repurchases. That track record instills confidence.
Okay, that's a pretty compelling full case. M&A, energy codes, housing shortage, good capital allocation. Now, what about the risks or challenges that can make investors cautious? What's the bear case for IBP?
Right, the cautious or bear case for IBP is rooted in several potential value destroyers or serious headwinds. First and foremost is its profound cyclical exposure. We keep coming back to it because it's so important.
Can't avoid it.
The company's heavy reliance on the U.S. new residential construction market makes it highly vulnerable to a housing downturn triggered by high interest rates or a broader economic recession. A significant drop in housing starts would severely impact revenue, profitability, and cash flow. Period.
Okay. Cyclicality is risk number one. What else?
Second, there are inherent risks to the roll-up strategy itself, even though it's a strength. The aggressive acquisition strategy is not without peril. The pressure to continuously deploy capital could lead to overpaying for assets, especially if they acquire too aggressively at the peak of a market cycle.
Buying high.
Right. And a major integration failure or maybe a series of underperforming acquisitions could lead to significant goodwill write-downs, which means directly destroying shareholder value. So the execution risk on M&A is always there.
Makes sense. What's the third bear point?
Third, there's the question of peak margin sustainability. We touched on this. Current profit margins for IBP are at or near historical highs, achieved during a period of strong housing demand and robust pricing power. These margins may simply not be sustainable through a full cyclical downturn. Pricing power could erode, and labor costs are likely to remain elevated, putting pressure on profitability. Expecting peak margins forever is usually a mistake.
Okay, margin risk.
Yeah.
And finally,
there's valuation risk. The stock's valuation premium relative to its primary peer top build suggests that a high level of growth, probably driven by M&A, is already priced into the stock.
High expectations are baked in.
Exactly. So any slowdown in the acquisition pace or a cyclical decline in earnings that's worse than expected could lead to multiple compression. That means the market assigns a lower PE or EBITDA multiple to the company, resulting in underperformance for the stock, even if the business itself is okay.
Got it. So cyclicality, M&A execution, margins, sustainability, and valuation risk. That's a solid bear case. This brings us to some key questions for you, the listener, to consider as you reflect on IBP's story. What are the absolute key factors driving IBP's long-term value creation?
I'd say the primary driver is the successful and disciplined execution of its acquisition-led consolidation strategy. That's what allows the company to grow faster than the underlying market organically. But, and this is crucial, this must be coupled with the ability to maintain margin discipline and effectively manage its capital structure, especially its debt, through the entire housing cycle. Both execution and financial prudence are critical for sustainable value creation.
And another important question for you. How sustainable are those current high margin levels through different market cycles?
Yeah, that's a huge one. Current margin levels have benefited significantly from a strong pricing environment recently. Their sustainability is a key uncertainty. While their purchasing scale and any operational efficiencies they achieve provide some support, a significant housing downturn would likely lead to pricing pressure from builders, and some degree of margin compression seems probable. However, that secular trend of higher value work due to increasingly stringent energy codes could provide a partial offset. So even if margins per job type compress, the average job might become more complex and valuable, cushioning the blow somewhat. It's complex.
What about the runway for growth? Can they keep buying companies at this pace? What is the runway for continued acquisition-driven growth?
That's another great question. The installation market remains highly fragmented, which definitely suggests a long runway for continued consolidation on paper. There are still thousands of potential targets out there. The primary constraints are likely not the sheer number of targets, but rather the availability of attractive targets at reasonable valuations, and critically, IBP's own internal capacity to successfully integrate them without operational disruption or overstretching their management team. It becomes a matter of quality and integration capability, not just quantity, especially as they get bigger.
And just to reiterate, how exposed is the business to new construction versus repair model activity? We know the answer, but it's worth emphasizing.
Yeah, it's stark. The business is overwhelmingly exposed to new construction. Residential new construction alone accounted for that huge 72% chunk of 2024 revenue. The repair and remodel segment is simply too small, around 6%, to provide any meaningful countercyclical balance. It won't significantly offset downturns in new builds for IBP as it's currently structured.
And thinking about moats again, what competitive moats does IBP possess, and how durable are they really?
Right. IBP's moat, as we discussed, is probably not primarily in its installation service at the local branch level. That service is largely a commoditized business with lots of competitors. Its truly durable competitive advantages seem to be at the corporate level, its national scale, which provides superior purchasing power from manufacturers, and its well-established, reputable M&A platform, which gives it a distinct advantage in consistently consolidating the industry. Those are harder for competitors to replicate.
So scale and M&A expertise are the core moats. Finally, how should investors think about the optimal valuation for this type of business, a cyclical grower driven by acquisitions?
Investors should really view IBP as a cyclical growth company. That means the optimal valuation should likely be based on some form of cyclically adjusted earnings or cash flow multiple, one that normalizes performance over a full housing cycle. Valuing the company at peak earnings with a peak multiple would be a significant risk. You'd be buying at the absolute top, assuming the good times last forever. Conversely, valuing it at trough earnings with a trough multiple when everything looks bleak could represent an opportunity. The current valuation, as we noted, appears to be positioned somewhere between these two extremes, suggesting the market has some expectations for continued growth, likely from M&A, but isn't necessarily pricing in peak performance indefinitely. You need to form your own view on where we are in the cycle and what normalized earnings look like.
What a deep dive. We've really unpacked IBP today, haven't we? From its disciplined acquisition strategy and heavy reliance on the housing market, to its impressive financial performance track record, and also the significant risks it navigates daily. You, our listeners, should now have a much more comprehensive understanding of what makes this company unique and what key things to watch for as it continues its journey.
Yeah, and this raises one final important question for you to mull over after we sign off. Given IBP's specific reliance on continuous acquisitions and its light touch integration model, how might the next severe housing downturn uniquely test their particular strategy? What specific indicators might you watch for beyond just housing starts to understand its true resilience? Maybe look at their acquisition pace, deal multiples, debt levels, or how those same branch sales hold up compared to peers. It's about how their specific model handles the stress test.
Great closing thought. Thanks for joining us on this deep dive, everyone. Keep learning, keep asking questions, and we'll see you next time.